Shri Pratim Bandappadhyay ji, Chairperson PFRDA. You are very welcome, sir, and we thank you for sparing your valuable time. Chairman Sahab,
please start.
Shri Mohit Jain ji.
Yes, sir. Of course, sir. Please, let's start.
Yeah, please. Thank you. Dear friends, the Banking, Financial Services and Insurance Committee of PhD Chamber is extremely glad to partner with the PFRDA and GCCI for organizing today's webinar. GCCI is the Gurgaon Chamber of Commerce and Industry. Today's webinar to spread awareness on the pension schemes launched by the Government of India. In many developed nations, retirement is not so much of a worry because of a strong social security system provided by the respective governments. Unfortunately, in India, we don't have any such protection. We must plan for it ourselves. Even jobs then may not be live a complete retired life. Till some years, jobs, the pension, and the safest investment that everyone looked out for was the fixed deposits. So not only the senior citizens, even a large section of working population till now have the maximum amount of their savings in the fixed deposits, which everyone feels is the safest investment in today's time, as economy is challenged by so many worrying factors like coronavirus, and before that there were lot of environment. Sometimes the geopolitical impact the investment trajectory, and people are more diverted towards the fixed investments. Though it may be referred as safe still, but it is not at all a retirement plan, as it fetches a very meager return. It is important to start the retirement planning early in order to build a corpus large enough to give a regular income post-retirement. That is the thought process of today's environment. So choosing a pension plan with the required features allows one to enjoy retirement coverage with the many benefits involved. So today we have eminent speakers from PFRDA who will explain about each and every feature of NPS and its importance, the tax implications, and other related issues. So without taking much time, I invite at the outset Shri Mohit Jain ji, former President, Gurgaon Chamber of Commerce and Industry, for the welcome speech. Shri Mohit Jain ji, please.
Thank you, Sharma ji. Thank you so much. And a very good afternoon and namaskar to Shri Bandappadhyay ji, Chairman PFRDA, Ms. Preeti Chandrasekhar, India Business Leader, Health and Wealth and Fellow Actuary, Mercer, Shri Sunil Nair, Senior Consultant, Mercer, Shri Mono Ukon, General Manager, PFRDA, Ms. Beroz Kamdeen, Partner, Deloitte Haskins and Sales LLP, Shri Sethi, Senior Member, BFSI Committee, PhD Chamber, Dr. Sharma, Chief Economist and Deputy Secretary General, PhD Chamber, delegates, friends from media, ladies and gentlemen. A very good afternoon to all of you and welcome. Friends, Gurgaon Chamber of Commerce is extremely happy to collaborate with PhD Chamber and PFRDA in organizing today's webinar on securing retirement with NPS and Insights for employees. It is a very crucial subject, and it is extremely important that each one of us is sensitized on the importance of retirement planning. It is my privilege to welcome Shri Supratim Bandyopadhyay ji, Chairman PFRDA, for his participation as a keynote speaker for today's webinar. Friends, Gurgaon Chamber of Commerce and Industry was established in the year 1979. It is a 40-year-old chamber serving the state of Haryana. Gurgaon Chamber has select membership of about 350 units comprising of small, medium and large sector. The chamber is serving Gurgaon, Udhog Vihar, Rose Ka Mayo, Manesar, Kotadi, Daruveda and Bawal industrial belts. The chamber is recognized as an effective spokesperson of industry in Haryana and is represented on various councils and committees constituted by the state and central governments. The chamber is incidentally also coming up with its own secretariat building at IMT Manesar. And friends, as Dr. Sharma has already given a brief, and I echo the same, in many developing nations, retirement is not so much of a worry because of the strong security system, social security system as provided by the government. But unfortunately in India, we don't have any such protection. Therefore, we must plan for it ourselves. Even for people engaged in government jobs, the pension may not be enough to live a comfortable retired life as they go on in the future. Retirement planning is an essential part of financial planning of one's life for leading comfortable and dignified post-retirement life. An increase in average life expectancy has increased the importance of retirement planning. Planning for retirement not only ensures an additional source of income, but also helps in dealing with the medical emergencies, fulfill life aspirations, and to be financially independent. Friends, retirement planning must be an extremely important aspect in everyone's life today. Most people are aware of this fact, but they're not aware where to start. It is important to adequately provide for retirement while factoring in your taxable interest income and various exemptions. It is prudent to start retirement investments early, even with small amounts each month, to build a substantial corpus for a stress-free retirement life. Choosing a pension plan with the required features allows one to enjoy retirement coverage with benefits involved. The Government of India rolled out the National Pension Scheme in 2004 as part of a social security initiative for all Indian citizens. The NPS scheme allows individuals employed in public and private sector to invest in low-risk equity funds, security funds, or alternative investments with good returns. The government gives special tax exemptions for contribution towards the NPS by employers on behalf of employees under the corporate mode. Friends, today's webinar is an aim to sanitize all participants with national pension schemes, its benefits, and detailed features along with tax implications and insights for employers. I'm sure the team, PFRDA, and all eminent speakers today will enlighten us on the scheme and clear any doubts and bring awareness for willing investment in the scheme. With these words, I once again welcome you all and look forward to a knowledge-enriching session. Thank you. Over to you, Sharmaji. Thank you, Sharmaji.
Thank you, Shri Mohit Jainji, former President, Gurgaon Chamber of Commerce and Industry, for your very deep insights and practical aspects and the importance of the insurance in today's environment and the benefits associated with it. So now I invite Shri S.K. Sethi ji for moderating the program and inviting the esteemed dignitaries according to the schedule of the program. Shri S.K. Sethi ji, please.
Dr. Sharma, can you hear me? Dr. Sharma, can you hear me?
Yes, yes.
Yes, sir, you're audible. You're audible.
Yes, sir.
Okay. Thank you, sir.
Please go ahead, sir. Please. Thank you.
Thank you very much for giving the background of the pensions and its importance. And now it is the time that we are having dignitaries in front of us and they are available. So I will take this opportunity of introducing Shri Supratim Bandyopadhyay ji, who is the chairman of Pension Regulatory Authority. He has been the chairperson of this Regulatory and Development Authority since 21st of February 2020. Prior to this, he had the position of whole-time member for 2 years. He has vital experience in the field of insurance and has served 3.5 decades in life insurance of Corporation of India, the largest insurance body, which is also very much engaged in investment of the savings of the people and policy holders. His areas of expertise include finance and investment, and Shri Bandyopadhyay has served on the board of Central Board of India. He was in the supervisory committee, investment committee of various funds, venture funds and alternative investment funds. He was also on the board of Fixed Income Money Market and Derivatives Association of India for 6 years. He is a science graduate, qualified chartered accountant, and we are honored that he is with us today to tell to us about the Regulatory and Development Authority, that is PFRDA. Welcome, sir.
Thank you, Mr. Shetty, for a nice introduction. Good afternoon, Dr. Sharma, Chief Economist, PhD Chamber of Commerce and Industries, Mr. Mohit Joel, President of, or ex-President, I believe, pardon me, ex-President of Withdrawal Chamber of Commerce, and other officials from PhD Chamber of Commerce and Industries. I thank you, as well as I thank Withdrawal Chamber of Commerce and Industries for joining hands with us and providing this platform. I believe Withdrawal houses a lot of industries, small, medium, micro, and I believe through this panel, we can share some thoughts about retirement benefit solutions and pension and its importance. At the same time, I thank my co-panelists for joining here today, and they will be giving different aspects of pension. One is Ms. Preeti Chandrasekhar, very senior fellow actuary with Mercer, and her colleague Sunil Nair. They will be talking about their experience with the employers and employees, what they want, so far as retirement benefit solutions are there. We have Madam Behrooz Kandi, a senior partner from Deloitte. She will be talking about the tax implications. And my own colleague, Sri Mono Fukan, Chief General Manager of PFRD, he will be talking about the product per se. What is NPS? What are the benefits? What kind of flexibilities are there? And how people can join and create a purpose for their retired life. When we talk about pension, we see that this is one decision people want to postpone when they join their service. Maybe they think that retirement is still away another 30, 40 years, so why start talking about pension now? Why start saving some purpose for it now? But I believe that that is the time when you have to do it, because it is not a one-time solution. Pension, you cannot have a one-time solution. You have to build up a corpus. It's just like creating a big edifice brick by brick. So similarly, you also have to just generate a huge corpus which is required at the point of your retirement. And that effort should start as early as possible. I believe Dr. Sharma and Mr. Jain has already talked about the longevity. Longevity is no more a boon. Actually, it has become a big liability. And today, if we are not prepared to meet that post-working life period of 16, 18, 20 years, then it becomes very, very difficult for anyone to pass even maybe a single day post-retirement. And if you don't have enough corpus with you, there is always a chance that whatever little you have will be outliving that. And there will be a period of absolute uncertainty. If you look at the pension ecosystem in India, already there was some discussion that other countries, they have their social security network. Yes, they have it. So whatever systems they follow, normally they call it a three-pillar kind of a system. Basically, there will be a social security network. On top of that, there will be mandatory pensions, and these are normally given for government employees who will contribute. Maybe the employer also will contribute, and together they will build up a corpus. And there is a third pillar, which is normally they call it a workplace pension, WPP. That is nothing but a voluntary sort of pension that a person may join. But what is there is that always there is a minimum amount of pension which is guaranteed through the social security cover. And on top of that, you add the second layer, whether it is a mandatory pension or it is a kind of a voluntary pension. I have seen the UK system very closely. We have gone there, studied there, and there that social security network is such. When we had gone, that was about 2 years back. That time, an individual used to get about £166 per week as the minimum support from that social security cover. And on top of that, if you have your mandatory or voluntary system, that adds to that and that enhances that total purpose. So already there is something built in, and thereafter you add to it. But unfortunately, what is happening here in India today is that minimum social security cover, it is there. I'm not telling it is not there, but it is only meant for those people who are below poverty line. And even if you wish, we cannot go and join there to get a minimum pension. And there the minimum pension also is very, very low. We have seen schemes like Indira Gandhi Old Age Pension Scheme and many, many other schemes which are targeted to different groups of population. So currently what is our ecosystem like is that there are many providers. It is very, very fragmented. And many people also sometimes get confused as to which is the real pension system. Today, EPFO also has a partial pension.
Sorry to interrupt. Sir, your voice is not really audible. The audiences are finding some difficulty in hearing you. So can you be a bit louder maybe?
Yes. Let us adjust the system.
There's some issue of audio. Maybe it's not very clear.
It's just output volume. Can you hear me now?
So it's very low. It's coming, but it's very low. And that's the problem most of the audience are facing. They are writing in the chat.
I can change my seat, go somewhere else, and maybe input comes. Is it audible now?
It is audible, but it's not coming at a very full volume. So maybe that's the problem.
Very interesting. Is it audible now?
Yes, it is audible now.
Good.
Yes.
Now it's good. Thank you.
Am I audible? I think there is a problem with this. It's volume. Problem. So sorry for the inconvenience. Am I audible now?
Yes, sir, it's perfectly fine now.
I think the speaker which was there in front of me, that was giving some trouble. Anyway, so what I was telling is that the pension ecosystem is very fragmented, and that creates a lot of confusion amongst the mind of the people. Today, EPFO manages a total fund of about 13 lakhs, 14 lakh crore. There is a EPS part, and that EPS also is treated as some source of pension. But if you look at it, the EPS gives a very, very limited amount of pension, and it in no way will meet the requirement of the person. Thereafter, there are insurance managed funds, superannuation funds. Then there are superannuation funds which are self-managed. They manage it themselves, and there are certain investment guidelines that they are supposed to follow. But there is no regulatory oversight to ensure whether those things are being followed or not. And obviously, thereafter, there was NPS. Already, Mr. Jain has told that in 2004, NPS started. Initially, it was with the central government people, because central government also thought that this is high time we go out of their earlier defined benefit scheme, which was actually putting a lot of strain on the exchequer, government exchequer, and they thought that it is ideal time to go out of these defined benefit schemes and go into some kind of a defined contribution scheme. The difference is that in a defined contribution scheme, both the employer and employee contributes, and a corpus is created, and out of that corpus, whatever annuity can be bought, accordingly the pension is paid. So beyond that 10% or 14% contribution that the employer makes, beyond that they have no further financial commitment. So the financial commitment is limited. After that was launched in 2004, and along with that, they thought that let there be a new regulatory body, because this is a new kind of scheme. So there has to be some regulator who will be looking after the entire scheme, how it runs. And we started way back in 2004 as the interim body of PFRDA, and thereafter the act was passed in 2013. That is for the history. But from 2009, we thought that why not give the same benefit that central government employees are getting, that same benefit of NPS, to retail customers and corporates. So slowly we opened it up to retail customers, then corporates, and then they started coming to us. Now, if you look at how things have gone for NPS, yes, we have grown at a very, very steady pace. And today also, if you look at it, in last 1 year, our customer base has gone up by almost 24%. Currently, we have a little over 4.5 crore customers. And the total asset base that we are managing, whether it is from central state government or from corporates or from our retail customers, all taken together, it is little over 6.5 lakh crore. And there also the growth rate is almost more than 33%. And the kind of CAGR that we are seeing there, we expect that maybe by the end of this year, 2022 March, our asset base will grow to about 7.5 lakh crore. And in the current year also, we are expecting to add more than 10 million new customers. What we are doing here, we are trying to, this is a very, very flexible system, and we are making some changes also. Even during pandemic, we sat back and thought that what could be in the interest of the customers. And accordingly, the first thing that we did is the ease of joining. Because during pandemic, as we see now also, of course, now a lot of restrictions are gone. But at the initial stage, what happened is that customers were not able to move. That way, nobody was able to move. Lot of restrictions on movement. So how they can come and join? Initially, there was a stage when everything was manual kind of thing. You have to fill up a form, you have to submit your KYC documents to a bank branch or maybe with a NBFC who is registered with us, and then they will take it forward. But we actually eased out the process, and I'm very happy now. Current year, more than 45% of our enrollments are happening only through online mode. And once you do it in an online mode, no physical form, no shifting of physical documents are required. You can join. Even UIDAI and Department of Revenue, they are kind enough to allow our record keeping agency to onboard customers through online Aadhaar e-sign. So that has made the process very, very easy and very, very seamless. A lot of people are joining. And current year also, the subscriber base growth in NPS, as we checked in August, is more than 63%. So things are happening. But whether we are at the right place, maybe not. Why not? As I said, our pension system is very fragmented. And if you add all the asset base of EPFO, insurance companies under superannuation funds, NPS, and many other pension schemes that are going around, it constitutes only 12 to 13% of India's GDP. And pension assets to GDP is one of the important factors to decide the financial inclusion index of that country. And there we are lying below many other countries. One of the reasons being that we are not reaching that level. There are countries where they have crossed even 100% of GDP. So of course, a lot of catching up we have to do in the process. So that's why we do this kind of sessions to create a lot of awareness amongst people, is that pension is a decision which is for now. You cannot defer it. If you are deferring it, you are doing at your own risk only. Many cases we find that people start planning in their late 40s or early 50s. And by the time it is too late. Because there is always, for a if you are talking about a salaried person, there is always a limitation. The salary puts a limitation as to how much I can really save. So that's why it is very, very important we start early. Even if we can contribute only a small amount, let us start with a small amount. And as and when we rise in our working life, obviously there will be more cash flow, more income, and out of that, let us allocate a larger proportion to NPS. NPS is a very flexible scheme. When Mr. Fukan talks about it, you will know. But it is so flexible that you can manage the scheme by paying only 1,000 rupees a year also. In a difficult year, if a person feels that I just want to somehow keep this account active, just pay 1,000 rupees a year. And if you have enough money in a particular year, you can contribute any amount. There is no sort of a cap as to how much you can pay. Government gives exclusive tax benefits. So if you look at it, even from a investment point of view also, which normally a person should not look at, there also it scores high above many other schemes. It has exclusive tax benefit. If you look at the cost, possibly the lowest cost financial product, not only available in India, but throughout the world. So much so, our fund managers take only 9 paise out of every 100 rupee that you give us for investment. Look at a competitive mutual fund schemes. It can be anything between, say, 1 rupee 50 paise to more than 2 rupees for equity scheme. I'm even talking about an active equity scheme that you can maintain here with us. We allow about 75% in equity if you wish, and if you have the risk-taking ability. If you don't want to do that and you want to play safe, go for government security. 100% you can put in government security. So only you will have some interest rate risk, but absolutely no credit risk, no default risk. So that is also available. So it is a mix and match. According to your choice, you come, you join, and you contribute and build up your corpus. Mr. Jain was talking about, or I think Dr. Sharma was telling about a lot of money lying in fixed deposits. I really wonder as to how they are really managing. Couple of months earlier, we have seen retail inflation at 6.3, and today what a fixed deposit is giving. Fortunately, now it has come down to 5.3, but still, fixed deposits are also almost at same level. So the real interest, the real return that you are getting is really zero. And it is eating into your capital in the long term. So that way, I believe people have to start early. And from there, I come to the corporates, and I believe they have a very big role to play here. More than 9,200 corporates are already there with us. But these 9,200 corporates only contribute towards 12 lakh people who have joined us. That means a large number of employees are still outside the ambit of NPS. Do they not require pension? Absolutely, they require. Each one of us require pension. And it is not only that that they are not capable. They are capable, they have the wherewithal, but only we have to tell them and show them the way that yes, you come here, you join us, and we'll arrange a corpus for you. So I believe all these corporates, those will be joining through the online platform, they also must realize that they have a huge role to play. And just by telling their employees, yes, you require a pension scheme, you require something for your retired life also, and start early. And I believe a word from your side will have a lot of positive effect on the entire employee force. Because if employer says something, they take it really seriously. Yes, from PFRDA side also, we are making efforts. Our distribution partners, banks and other NBFCs, they are also going and visiting your places to have meetings with the employees and all that. Of course, during this pandemic period, those kind of visits were really little less because of the restrictions put on the movements. But slowly with, I think, lockdown restrictions going out, I believe more such visits will be there. Even if it is required, if the corporate wants some word with the PFRDA, we are ready. We are ready to go all through, join through a webinar and clarify their doubts so that they can join. Very big corporates, central public sector enterprises, they are joining us. Currently, 2 large companies who are in the process of joining and large number of employees who have joined is Steel Authority and Life Insurance Corporation of India. Their own employees, those who joined after a particular cut-off date and who are given NPS, all more than 20,000 people they have joined. I believe Steel Authority on the last count, more than 45,000 people have joined us. And apart from that, a host of other CPSCs, they have already shifted to NPS. because they feel and they see that there is a safety net. It is really regulated very closely by the regulatory body. Pension fund managers are doing a good work. Lastly, I'll end with some kind of figures. Of course, it will be there in subsequent presentations also, but just to highlight how the fund managers are doing. 2009, we opened it up for retail contribution. Since then, our equity fund in over 12 years now, it has generated a CAGR, compounded annual growth rate of 13.6%. And this is, I'm talking about 9th of September 2021. Up to this period, the returns are available. Our corporate bonds have given 10% return for these 12 years. The only fund which has given little less than 10% is government security. Again, because there people want to play safe. There are people, they say that I'll give away 2-3% of return, but I want to play safe. Fine. But there also we are giving more than 9.5% return over 12 years. So if you look at it, even EPFO balance sheets are out 2020. You can check for yourself what kind of returns the fund managers. They also have independent fund managers. There, what kind of yields the fund managers are generating on their funds. On a given day, there is at least a differential of more than 3%. So look into all these things, and NPS that way is a one-stop shop with all its flexibility and the cost benefit that is added with it, and exclusive tax benefit. I believe if you look about retirement solution, you have to think about NPS. So a nudge, a word from the employers, I believe will go a long way. And once again, before ending, I want to thank all of you, those who have made this possible today and those who are joining today. And I believe we'll have a lively session, and post that we'll try to answer all your questions which are coming through. Thank you so much.
Thank you so much, sir, for your expert insights. And naturally, in the coming presentations and the comments which we will be having, we will be able to come out with very good discussion. I would now like to invite Madam Preeti Chandrasekhar. She is the head of India. She is India Business Leader, Health and Wealth, and is a fellow actuary in Mercer. Mercer is one of the leading company which is operating worldwide, and of course very much in India also. And she will be talking to us, telling us about retirement benefits planning, and let us hear from her. And as I told you that she is the India Benefits Leader, and she is having 29 years of management consulting experience in insurance, retirement lines, other employee benefits, extensive experience in design and delivery of benefits, including employee communication for better employee engagement in voluntary benefit programs. She has designed, delivered program management of end-to-end NPS implementation, including emails, intranet, webcasts, help desk as support in senior stakeholders. She has authored several international and national papers which have been highly appreciated in the world. Over to Madam Preeti. Thank you.
Thanks a lot, Mr. Sethi, and a very, very good afternoon to all of you. Thanks to GCCI and PFRDA for giving Mercer the opportunity to be a knowledge partner on a subject that is perhaps one of the most relevant and pertinent topics. The previous sessions actually gave us a wake-up call from our slumber, and we realized that very few of us are ready for retirement. It is not just in India, across the world also, and I will show some statistics in that. And we also realized that, and the Chairman PFRDA talked about how the younger generation keeps postponing thinking about creating a retirement corpus. And he also stressed on the fact that pension is a decision for now and cannot be deferred. If we can share the slides, please. Do we have the slides?
Can you share the rights with us?
You're telling me, sorry. I think the slides have been shared, right, Sunil? If you could just, yeah.
Monica, can you share the right with us? Yeah, thank you.
Yeah, it has been done, sir.
So we move on to slide number 2. The next slide, please. Yeah, thank you. So what are we going to be discussing in these next few slides between me and my colleague Sunil is what is the real issue that we're talking about? And so what? You know, okay, it's an issue, so what? And then what next? So see, these are the 3 ways in which we've tried to divide the session. We move on to the next slide. Can we move on to the next slide, please? Yeah, no, the one after this. Slide number 4, please. Hello? Can you hear me?
Yes, yes. We can hear you.
Yeah, yes. So I can I request you to move to slide number 4, please? Yeah, the next one. Yes, thank you. So what are we seeing here? I think all of us were talking about how some other countries are better off as compared to us, that they have a defined benefit pension system. We don't have any kind of a social security. But you know what? Living longer and aging is a reality across the globe. And pension systems everywhere, including social security systems and private sector arrangements, are actually under a lot of pressure. So if countries have had a defined benefit system, they are under pressure for different reasons. And in countries where we do not have any such system, it is the individuals who are under pressure. So it's either the sponsor who is under pressure because they're not able to pay, or the individuals are under pressure because there's no such system. So eventually at a macro level, I think every country is under some pressure or the other. In India, you know, life expectancy at 60 is expected to be 80. So we're talking about another 20 years for which we will live. And we have moved from a defined benefit arrangement to a defined contribution arrangement. So obviously there's more responsibility on the individual. And recent low interest rates that we have seen across the world have actually particularly affected DC systems. So in a nutshell, systems are under pressure due to various reasons the world over. Now look at India. What has happened is, you know, we all thought that India was fortunate enough to have a demographic dividend, but I guess that's not the case anymore, because recent statistics published by the National Statistical Office Elderly in India report in 2021 said that India's elderly population, that is people who are 60 and above, is projected to increase by a whopping 41% in the next 10 years from 2021 to 2031. So clearly we are not in a very comfortable position, either at a macro level or at an individual level. If we move on to the next slide, this is some more statistics that we would like to share with you. Yes, thank you. So this is about an index that we have, which is called the Mercer CFA Global Pension Index, which is an annual index that we calculate, which talks about 3 key things on adequacy, that is what will one get during in a country. And second one is how long will one get, that is sustainability. And third is there a risk of default? Indian system, the efficacy of the current system is compared to about 38 other countries. while if you don't focus on the ranking, what I want to focus on from an India context is three key things. One is we have no social security system for the most part, except for the poorer section. So we are pretty much left to take care of ourselves. The second point is there is very low coverage under private pension arrangement. That's just about 6%. And we are all, so today's session is about corporate NPS, and nothing could be more relevant than that, given the fact that the private pension arrangement is very low. And the third thing that I would like to highlight is we all love flexibility. All of us cry foul when we say, oh, I have to wait all these years for getting access to my retirement corpus. Oh, I don't have flexibility on withdrawal. Oh, I mean, there's a lot of things that we talk about when it comes to the lack of flexibility. But we have to understand that if we get access to money before retirement, we don't realize that the flexibility has to be accompanied by a sense of responsibility that we have. And the more flexibility we have, the more responsible we become as individuals to take care of our own corpus. If we move on to the next slide, this again. Yes, thank you. This again is about the scale of retirement challenge in India. And we see that we've just compared India and China, and they have the fastest growing gap of 10% and 7%, which is essentially a gap between it is actually shortfall in the pension savings through a retirement versus a savings gap. And again, we talk about India, we see a large number of people in the unorganized sector. So obviously they are not covered in any sense. And then we have the growing middle class, and we've had such an improved quality of life. So what happens is we are so used to a certain lifestyle pre-retirement that post-retirement it gets more challenging. And I'm sure all of us will agree that it is very different from how our previous generation used to be, how much more simple their lifestyle used to be as compared to us. So if we have a lifestyle which is very different, obviously the demands on our retirement income will become that significantly higher. We move on to the next slide, a very quick input to you on how the balance sheet of a typical Indian household looks. So if you look at the balance sheet here, interestingly, the asset side, we see that high amount of wealth, roughly about 90% of assets are allocated to physical assets like gold and real estate. And clearly there's a severe amount of underinvestment in long-term insurance and pension products. You look at the liability side, I talked about the aging population. We are seeing that pension and insurance have become very serious issues as the elderly cohort grows. So we don't anymore have a demographic dividend, and looking at the rate at which the population is aging, I think this is something that is of concern to all of us. We move on to the next slide, please. Okay, so now we are saying, why is this such a big deal, and why are we talking so much about it? What is happening to our earnings while we are on a job? We see that there is competition amongst too many forces operating on our salary. We have, do I actually save money for the house? Do I put it away for a holiday that I want at Bali, or I want to cruise around the world? Of course, not practical in the past few months, but it's quite likely that we'll start thinking about it again. Do I put it towards retirement savings, or do I put it towards eating or actually dining out, enjoying myself, partying out with friends, which is also something that I like? And so there is too many forces acting on the annual income, monthly income that I get. What happens when I move to retirement? If I move to the next slide. We are saying that for the same rupee I get from my retirement income, there is too much competition again. Maybe not a mortgage, maybe I have paid off my loan, but I still want that holiday, because I remember all of us are living longer, so we still want to do those holidays which we couldn't take because during our working life. Medical expenses. I'm expected to live longer, but would I live as healthy? I'm not too sure, which means my medical expenses are likely to be high. And we don't have, in the corporate sector in India, we don't have any kind of a post-retirement medical plan. So I have to pretty much take care of my own expenses. And if, God forbid, I need some kind of a home care, I still need to pay for it. And after all that, I perhaps still need to save because there are many other things that I would like to spend on. So now I move to the next slide and give a perspective on thinking, you know, oh, well, we have Provident Fund, we have gratuity. My company has got gratuity, which is very generous. My company pays on full Provident Fund contribution is on the full basic and not restricted to 15,000, etc. I may think that, you know, right now, if I project for myself for 15, 20 years down the line, I think that's going to be a significant amount of money. But you know what, maybe it's not that enough, because what we are seeing is that if you look at this particular slide, when we are talking about the sufficiency of the employer-sponsored plans, we see that if you continue working without a gap from age 25 till 60 and your wages increase every year, then you're just about reaching a position of maybe or 25 to 30% of the last drawn salary. And if I include my basic minimum corporate NPS program that I have, that increases to about 33 to 40%. Is that enough? Maybe not, because this also does not take into account any loss of job, premature retirement, etc. And when these things happen, the spreadsheet model really falls apart. So very clearly, if we think that we have Provident Fund, we have gratuity, that's good enough for us, it's time for us to sit up and think, you know, this is not going to be sufficient at all. If you move on. So this is all about what is at a macro level, what is happening to me during my my employment, what is likely to happen to me when I retire. All this said, what is the role of the employer over here? So if we move on to this slide, which is very interesting for us to see that Chairman Sir talked about in his presentation, he talked about 9,200 odd companies who are enrolled under the corporate NPS program. There are only 12 lakh employees who are subscribed to it. So clearly this is grossly insufficient. And if companies are thinking that, employees perhaps will take care of things for themselves and they may not be interested in the company intervening in any kind of a program, we have seen in our studies that employees' well-being can be directly impacted from the employee engagement standpoint and productivity. So clearly, employee engagement and productivity gets impacted by employee state of well-being, and so employers are increasingly looking to better understand their own employee financial wellness and how they can improve the state of well-being together with the employees. What are we seeing here? We are talking about what is it that the employees think about the role of employer. And we are not talking about individual retirement planning here. We're just talking about the role of employers. So what delivers employee respect in India? Employees prefer to work in an organization. If you look at the top part of the slide, we see that amongst other things, 43% employees look at support on physical, physiological, and financial well-being. Look at the left side. With wage stagnation or lower increments, employees are looking towards employers for support on financial wellness. Yet, if you look at the right side, right bottom of the slide, only 29% provide financial education for employees. So clearly, there's a lot that needs to be done. Another interesting slide, if you move on to the next one. So here we see, which is again interesting, that why do employees join, stay, and leave an organization? What matters most to employees in India who are joining, staying, and leaving? You see pension and retirement options and financial well-being initiatives actually feature in all three. So clearly, they are important from an employee standpoint. Employees expect employers to do something about their retirement plans. And what are we seeing? If we see, some sound bites from employers that we are seeing. So we have employees wanting employers to give some kind of a support. And then if we move on, we see what the employers are seeing. If you move on to the next slide, please. they recognize that employees go through some kind of financial stress. And especially what has happened in the past 18 months has highlighted the importance of considering the different dimensions of financial well-being of the employees. And, employers are saying that we often think that we know what is important for individual workers, yet individual employees have varying personalities, preferences, and challenges. So there's no one-size-fits-all approach to addressing financial wellness. Employers really need to examine the various financial priorities and struggles of different segments of employees in order to strategize how they are able to offer appropriate benefits, develop an effective communication strategy, and deliver the right benefits at the right time to a diverse workforce. So this is what we talk about in terms of what we think employees want employers to do and what employers think that they should do. Yet there's a gap. Going back to what Chairman Sir said, 9,200 companies and just 12 lakh subscribers. So there's clearly a huge gap. And the next few slides will be talked about by Sunil Nair, my colleague from my team, and he will give you a hands-on experience of what he thinks is something which is required for organizations to have a very effective and engaging NPS program in place. Over to you, Sunil.
Thank you, Priti.
Thank you, Priti, for your very good presentation. And now we are having Mr. Sunil Nair. He's senior consultant with the same corporation, Mercer. And he is having 20 years of experience in pension consulting, life insurance, and banking. He has also designed, delivered program management, end-to-end corporate NPS implementation in the country. He has led COE for new labor code offerings for corporates. He is an expert in insurance product evaluation and program management. He has very wide and rich experience in client management, business sourcing, key accounts management. He has also led strategic and growth initiatives for the company Mercer. Over to you, sir.
Thank you so much, Mr. Sethi.
Thank you.
Welcome, warm greetings to everyone. While Preeti spoke on the global and the Indian retirement landscape with statistics, and even touched upon the employer and employee perspective, I will cover a little bit more in detail what our practical experiences have been as a consultant, what critical success factors are there when we support organizations with regard to corporate NPS implementation. So if you see this slide, we would like to share some thoughts of our clients and their employees on retirement benefit and planning. This slide will give you an employee and employer perspective. What is shown is different generation of employees working together, but each with their own mindset of saving and retirement planning. For example, a younger lot, they earn well. They would rather enjoy the present, spend a lot of time, spend a lot on items of their choice. However, saving for future often takes a backseat. Hence, perceived value of retirement benefit is quite low here. Just opposite, for a middle-aged, a slightly older person, retirement saving or a sustainable standard of living post-retirement becomes one of the priorities. As age goes by, concern for post-retirement income is always ticking at the back of our mind. As Chairman Sir also stated, retirement planning is a decision for now and not to be kept for a later stage. And we as a consultant completely back that statement. From an employee perspective, we have seen what they look for is minimum administrative burden and fiduciary responsibility when they look forward to implement or even evaluate any retirement program within their company. They would always like to play conservative without any risk on investment for their employees. Employers also believe that higher and better the employee engagement is, higher is the success of any such retirement plan. They are also conscious of the fact that each age group have different priorities and their attitude to save for future differs accordingly. Hence, taking everyone together on this journey does become a challenge. On the right-hand side of the slide, if you see, it actually talks about the employees' priorities. what they look when they choose for a retirement plan or any saving plan for that matter. They look for flexibility, they look for simplicity, higher return, and overall holistic approach to financial wellness, and not just sticking to any one kind of a product or investment. And honestly speaking, NPS, the corporate model of NPS or even individual model, really fits into this scheme of things. The next slide, please. So what will work well? How can employer help? What challenges they face? Let's see in the subsequent slide. So today, from a Indian pension perspective, we have seen organizations offer superannuation and NPS. Some offer both. However, now more and more companies are moving towards NPS. And I would say in last 1 year or so, it has drastically increased the number of corporate registrations, the way it has gone up. But yes, there yet remains a challenge. The challenge remains is the take-up rate. So we have seen NPS steadily becoming popular in corporate model. The take-up rate is a challenge. The reason behind, we all know it's a voluntary pension scheme. So engaging employees together is challenging. Topics related to financial wellness does not always excite all age groups. We have also seen just an education section on retirement planning for employees does not prove to be very effective always. So having said that, what will actually make a difference? Based on our own experience as a consultant, we feel effective and personalized communication have a positive impact and result in higher engagement as well. So we all know today NPS is a product with some appealing features, and last year or so it has actually a lot of reforms has happened in terms of tax, in terms of withdrawal. It is the ministry and everyone, the regulator, all are trying to make it more and more attractive. However, this needs to be communicated to the core, to employees in the way they understand better. Next slide, please. So let's talk a little bit more about the challenges for both stakeholders. Here we are referring to employer and employee. To start with employer, for most of the multinational companies, the global buy-in is imperative. Their parent companies in somewhere outside India, so they have to be convinced first. So this entire process takes time. You know, the global won't like to understand the NPS program, then the local teams comes over. So it's a time consuming, and the decision to even launch the schemes it get deferred for a later stage. Payroll, a lot of companies are actually depend on a third party payroll provider. So that's another factor or challenge for employers, because their system needs to be ready to incorporate NPS as one of the components. Any delay in that end would also delay the entire implementation program. Employee engagement and internal operational support are equally an important tick in the box to decide for any such implementation. So for employer, all these three parameters are very important. To come on the other side, you and us as an employee, we all are at different levels of well-being, and the responses to company initiatives are different. I would still be attracted to a luxurious watch or a car. Retirement saving could take a backseat. So priorities are different. Another common issue, employees are really unsure when to start saving, how much to save, what is the ideal time. That guidance is very much required. They have the intent to save, but when is undecided. And rather the decision to invest gets deferred every time. So it's fair to say lack or inadequate financial literacy within the employee group is a big challenge today. We also feel right balance between employee expenses and saving is another issue employees face, and this imbalance would further result in no or inadequate retirement planning. They earn well, but what percentage to save? So that financial literacy is very, very important. Next slide, please. This is the final slide, an important slide rather. What would ensure a success of NPS program in an organization? We all know the success is measured by the take-up rate. Higher the take-up rate, higher the success. But what will make it work? As I mentioned, effective and personalized employee communication does make an increase. It does make a difference to the increase in percentage. If the employees relate themselves to the concept of retirement planning and not just restricted to one element, for example, only the tax part, they will surely opt in for the program. Right partner for successful implementation is equally important. So we know there are intermediaries involved in the implementation of corporate model. For example, a POP is the first intermediary, the point of presence. So it's very important to choose an efficient POP. So they ensure a smooth and a timely account opening and grievance handling. A satisfied employee would always speak high about the program with more and more employees. To ensure successful NPS program, a company should ensure regular engagement with their employees and not to treat entire implementation as one-time exercise. This is an ongoing exercise, and we have observed that many times. So just doing a session once in a year will not help. So we spoke about the intention action gap. That is equally important. Most important, I think the company leadership should be led by example. They should be convinced, enrolled in the program, and further convince employees on the relevance of the retirement planning. We agree with Chairman Sir. A nudge from employer will go a long way in ensuring success of the plan within the company. This brings end to our session. Many thanks for the patient hearing.
Thank you very much for your comments, and we have benefited a lot from that. And now I am having in front of us Shri Mono Fukon. He is the Chief General Manager in PFRDA, and he is speaking on National Pension System, product features and benefits for corporates. Mr. Fukon is working as Chief General Manager, and during his tenure of 10 years with PFRDA, he has worked across various verticals and has experience of promotions and development, fund management of pension funds, record-keeping operations, functioning of NPS Trust, which he worked for 3 years. Prior to joining PFRDA, he has worked with IDBI Bank as Deputy General Manager and with Corporation Bank as Product Manager, and his banking experience of 12 years are in the field of credit appraisal, retail assets, liability business, banca, alternate service delivery channels. He started his career long time back with Nestle India as the sales officer in the year 1998. And he is a commerce graduate, MBA and CAIIB. Over to you, sir, for your expert comments.
Thank you, sir. Thank you. I just not which way, I'll just go in fast. Basically, I'll just speak on the product part, its benefits and features, how to join, and what NPS is all about, what we have been talking about. So I'll just share some slides, and which gives us a brief idea of what the product is, what are the features, how to join about, and what benefits can we get derived from. So first and foremost, I'd just like to tell what are the best features of this when we have to say about NPS in a snapshot. So when we talk about the first benefit is that it is a portable account. It's a unique account. It's a pension account that has been a number that would get generated when a person applies for opening an account with the NPS. The uniqueness is that an individual can have only one account. And this account is transferable across employment, or it can be shifted from one employer to another. And it can be had or operated without an employer also. So it's not necessarily that a person needs to be having an employer to have that account. If he's a self-employed, he can have that account. If he joins another employment, then he can shift it, he can tag it to an employer. So the number is unique and it remains constant during the entire working life, and it can be shifted between employers and it can be maintained without an employer also. This is what the uniqueness of this pension account is. So we said that it's a permanent retirement account number, the plan that I have written. So the number is unique. And the next is that the cost of operating this account, the charges that are being paid by the subscriber in this entire system is one of the lowest. It is one of the lowest cost pension scheme, not only in India, it's across the globe. So the total cost over a period of 35 years on an average comes to around only 0.2%. So what happens is that it doesn't impact your corpus accumulation. So whatever you contribute, whatever the interest accruals or the earnings that has been there, that doesn't get depleted because of the charges. So you have a higher corpus for retirement basically when you get in the maturity mode. The next choice is about important thing is about choices. We offers a lot of choice. I'll have a slide on the choices that we have on the investment pattern, on the pension fund choices, how much you can change. That I'll talk about in the later part of the slides. Returns, as Sir has also been told, that we have been able to, our fund managers have been able to deliver attractive returns. I'll come to that, and it's a double-digit return, and we have a track record of 13 years, and it's comparable with all its competing products. It fares better. On tax part, a lot of tax benefits are there to the individual who has joined into this system. So Madam Deros will be elaborating in detail what are the benefits of tax benefits that are imbibed into this product, in this scheme, on contributions or during accumulation phase and at the point of exit also, the benefits. And transparency and online access is that you can access the account online. It is available on the mobile app. You can track all your transactions, the transactions that has been operated once the individual does. It is records are available. It can be viewed. It can be downloaded anytime. So all transactions can be tracked at any point of time, whatever the subscriber does into the account. And above and above over all this, it is regulated by our organization, which is a statutory body, and we give the guidelines, and the entities that are working on, we register them. So we put some checks and balances, we look after compliances and all, so the entire system functions in unison. So the basic thing that happens is that when you open in an NPS account is the Tier 1 account. It's a pension account. So this pension account is can be opened with only 500 rupees, and it has all the tax benefits. And the minimum amount that is required to open an account is 1,000 rupees. And there is no limit on the number of contributions or the amount of contributions that the person makes. So once the pension account is opened, the Tier 1 account is opened, the subscriber also has an option to open a Tier 2 account. That's an optional. It is not mandatory to open it, but the only benefit of this is that it doesn't have any restrictions of withdrawal. So this is like more of an account which is a running account, which is an investment account, where it's not a pension account, and you don't have much of the tax benefits into it, except central government employees have a tax benefit if they put it into this account with the 3-year lock-in period under ATC. And there is no limit on the number of contributions or in the amount of contributions. The next part is that how to join this scheme. So for joining the scheme, we have put in the condition that it should be an Indian citizen. It should be a citizen by mean it's a resident, non-resident, or an overseas citizen, any of them. And it should be aged between 18 to 70 years. So these are the only two conditions that have been in Indian citizenship and the age brackets. And certain KYC compliance are required, a photograph, address, and an identity proof. And this can be submitted online through Aadhaar and PAN authentication, or through physical mode by filling up an application form and submitting to our distribution channels, which we call point of presence. And they are mostly banks and non-banking financial institutions. So we have 93 of them. So if whatever financial relationship a person has with any entity, it can be done through them also by submitting a physical form. So once the account has been opened, contributions flows in. The minimum is 500 rupees to open the account and 1,000 rupees subsequent contribution. That's the minimum. As I told you, there is no limit on the number of contributions or the amount of contributions. And we have kept flexibility in the sense that it can be contributed by the employee himself, or if he has an employer, the employer can also contribute. So it's not necessarily that the employer and the employee should contribute both. Either of them can contribute. The employer can only contribute, the employee need not. So those flexibility has been there. If both of them can also contribute, and the proportion of contribution that the employer can be equal or unequal. So this entire flexibility is being kept into the account on the part of the contributions flows from either from the employer or from either of them, and in equal or unequal proportion if they both decide to contribute. It depends on the employee and employee relationship that they have. Once the funds have been deposited or the contributions flows in, it has been invested by the fund managers, that are pension funds. So we give them the guidelines. So universe of assets are investment instruments are given, and they declare the NAV at the end of the day of each of the scheme of the asset class. And with this NAV, the record keeper, who maintains the personal records and the account statement, means all the transactions into of the individual in the pension account, they allocate units to the subscriber with the NAV declared by the fund manager. So what reflects in the pension account is only in the form of units, and the value of those units can be are being declared by the pension funds, and the value of to the person or the pension account holder is the units multiplied by the NAV of the scheme to which he has chosen. So as and when the contribution comes, unit also will be allocated to the account, and this corpus will be growing over a period of time. So what happens is that once a corpus grows on, we say that a subscriber can exit the system, that the maturity proceeds can be withdrawn at the age of 60. So that we call it as a normal exit. So in that case, what happens is that 60% of the corpus we pay to the lump sum or in cash to the bank account of the subscriber, and 40% is mandated to be given to an insurance company for purchasing an annuity plan to derive that pension. So, and we have kept the condition that if the corpus is less than or equal to 5 lakhs, we pay the entire corpus in cash. And if it's not a normal exit, we say that after 10 years, somebody doesn't want to be remaining in the system. We say that, okay, he doesn't want to be part of the system and wants to withdraw. In that case, we say that only 20% will be paid in lump sum and 80% has to be utilized for purchasing an annuity plan from an annuity service provider or the insurance company to derive that pension. And if the corpus is less than or equal to 2.5 lakhs, the entire amount is being paid to the subscriber. And in case of unfortunate death, what we say is that the corpus that would be outstanding in the pension account would be paid to the nominees in full. And the nominees also have an option to purchase an annuity plan from the insurance companies that we have empaneled with us. The only benefit is that GST is waived. So once you move the corpus from NPS to the annuity service provider, GST is not applicable. That is currently 1.8%. So as I said, annuity service providers, these are all insurance companies, leading insurance companies, which have been empaneled with us to give the subscriber this annuity plans offered. So we have 14 of them. They have different varied plans. Their rates are also different on similar plans. On a broad basis, we have around 7 broad plans offered by all of them. So the subscriber needs to choose which plan to buy and from whom to buy, depending on his requirements, like whether he requires pension for himself or whether he requires 50% for his spouse or 100% of the pension to his spouse, and return of capital, non-return of capital, all those things has to be done. And then depending on that, he needs to select the plan and the provider. Regarding choices, as I've told, I'll come back to the slides. So the first choice is on the record keeper. We have 3 record keepers who maintain the personal records and the transactions that has been done by the subscriber. So there's NSDL, KFinTech, and CAMS. Any one has to be chosen. There's a slightly of cost differentiation, but the service standards are same. That has been monitored by us. And next choice is about a fund manager. Currently 7 are there. So 1 has to be chosen out of them. And this choice of pension fund and the record keeper can also be changed. Record keeper can be changed once in a year, and pension fund also can be changed once in a year. This choice is being given to the subscriber. And after this choice has been made, these 2 choices, you need to make a choice how the contributions that you make to the system or the subscriber making the contributions to the system, how it will be allocated between the 4 asset classes. That's equity, corporate bond, government securities, and alternate assets. We have limits on equity and alternate assets. Equity, we say that, okay, maximum 75% of your contributions can go into equity, not more than that. And only 5% can go to alternate assets, which are presumed to be more riskier than the equity. So these are the caps that has been put. And this choice also can be changed twice in a year. You want to reallocate between this 4 asset classes, this is also allowed. What we call is that when a person chooses between all these 4 asset classes, we call it as an active choice. The person, the subscriber makes his choice according to his risk appetite or his risk perceptions. The next is that when the person doesn't want to make an active choice, we say that he can go in for an auto choice. It's a predetermined allocation between the contribution between the 3 asset classes: equity, corporate bond, and government securities. So we have 3 life cycle funds. Basically, these are called as life cycle funds, and we have renamed that as LC75 or aggressive fund, wherein equity exposure is 75. And 10% to corporate bonds and 15% to government securities. And the last one is LC25 or the conservative fund. The middle one, LC50, is a moderate fund. So in the conservative LC25, we say that, okay, equity exposure is only 25%, corporate bonds 45%, and 30% in government securities. So in this 3 life cycles, what happens is that up to the age of 35, the proportion that I've shown you on the slides remains constant. And on the 36th birthday of the applicant or the subscriber, the allocation of equity reduces and the debt increases. So what happens in an aggressive fund, it reduces at 4%. In a moderate one, LC50, it reduces by 2%, and the conservative one, equity reduces by 1%. So by the age of 50, what happens is that you end up in an aggressive fund at the LC75, 15% equity, and 10% in the moderate, and 5% in the conservative one. So from 36 to 58th birthday, everything goes on reducing between the equity proportions, and from 51st year, it remains constant till the age of 60. So this choice also can be changed twice in a year between active and auto. Between auto also you can change between aggressive to moderate, moderate to conservative, and vice versa. And from auto to active also can be done. So whatever choices between the asset classes, that is allowed twice in a year. Returns, yes, we have told you that we have been able to deliver comparative returns or competitive returns and other competing products. So equity over a period of 12 years has given a 13.6%. These are all average returns of the 7 fund managers over a period, CAGR returns. And corporate bonds are 9.97, government securities 9.5%, 9.53. Central government secured scheme is a hybrid scheme or a composite scheme. When equity exposure is almost 15%, corporate bonds is around 35%, and 50% in government securities. So we have a track record of 13 years of a composite scheme of 10% over a period of 13 years. And state government securities, similar pattern of 9.93 we have, which we have a track record of 12 years. So just to give you a highlight of what the corpus is of the entire system as such, what PFRD looks after or what PFRD manages right now at this point of time. The figures are of 11 September. So we have total subscribers around 4.5 crores, more than 4.5 crores, of which we have 2 government schemes, that is Atal Pension Yojana and NPS Light. Almost 3.5 crores is from these 2 schemes. And 75.75 lakhs is from the government subscribers, central and state, and almost 30 lakhs 50,000 is from the non-government sector that we call as the voluntary subscribers joining the scheme. And we have a corpus of 6 lakhs 57,000 crores, and almost 3 lakhs 32,000 crores is from the government. 1 lakh crores is from the voluntary segment, and 22,000 crores from coming from the central government schemes that we manage. Accessibility, as I told you, that all transactions can be tracked by the subscriber himself. The transparency is such that we give them a login to this account, and this login is web-based also, and passwords can be generated online. It comes to the mobile number. So this the user ID is the account number itself. That's a permanent retirement account number or pension account number. And we have launched the mobile app also. So here also in the mobile app, it becomes handy to see the transactions, what has been done. You can see your value on a daily basis, but it doesn't make sense to look on a daily basis. And you can do transactions, you can contribute, you can change your fund managers, you can give partial withdrawal requests also. So all these things has been facilitated on your mobile also. So this is available both on Android and iOS, and on the web page also it is there where you have a login. Lastly, I'd like to highlight one of the important things that we as a regulator look into. If the subscriber has a grievance, we have a mechanism for a resolution. We have a regulation for that. And we have certain timelines also in those regulations that it should be resolved between certain timelines, and have an escalation matrix, keeping in mind the subscriber should not be aggrieved of any of the facilities that we offer or in the system of the services that will be offered by the service providers. So if a subscriber has a grievance, it should be lodged on a central grievance redress portal we have. So that can be online, it can be emailed to us, also it can be given a physical letter. So once it has been received in the system, we have a time frame of 30 days for resolution by the intermediary, and if the resolution provided is not satisfactory, it can be escalated to the trust, NPS trust. And after that also, if it's not satisfied with the resolution, it can be escalated to ombudsman, and after that the authority. And even after that, the subscriber is not satisfied with the resolution being provided by the authority of PFRD, he can again represent those things to the Securities Appellate Tribunal. But as on date, none of the cases have moved to that stage. In fact, all gets resolved within the timelines that is set for the intermediaries. Hardly any cases for the Ombudsman and for the authority. So thank you for this, and over to Mr. Sethi, and we'll be open for questions at the end of the session.
Thank you, sir. And it's great to listen to such a very, very clear concept and all that thing, which shows that you are really the right person to be the Chief General Manager of PFRDA. Now I would like to invite Madam Behroz Kamdin. She's partner in Deloitte India. She has 25 years of work experience in corporate and international tax to companies with focus on financial services and technology sector. She has advised Indian financial institutions on Indian tax laws, rules implementing US tax law, Foreign Account Tax Compliance Act, and OECD Common Reporting Standards. She represents clients at tax authorities and appellate authority and the Authority of Advanced Ruling. She is a regular presenter and writer on tax topics relevant to financial services sector. Thank you so much, madam, for your I have given your introduction, and now let us hear from you the most important aspect, that is taxation. Yes, ma'am.
Thank you, Mr. Sethi. Thank you, Mr. Bandyopadhyay, PFRDA and PHDCCI for giving us this opportunity to discuss taxation of investment in NPS. May I request Mr. Mono to share the presentation? So before we start with the presentation, I think all the speakers have given a lot of importance why we need to have retirement planning, why we need to have pensions, and why NPS. I think NPS has got some very good features in it, and therefore it's so important to know, and Mono spoke about all those features very well. So I think it's very important that we realize the importance of pension. And I come from a family where pension has been there, and luckily we have been fortunate enough to have pension. So in very early stage of my life, my father had passed away and we had got pension at that point of time, which was very critical and it was required. So we know the importance of pension, which is there. So when I joined an organization after completing my CA, that organization, it was a CA firm, the topmost CA firm in the country at that point of time. And they had pension for their employees. So even a professional services firm, which has restricted number of employees, still had pension facility. But there was a condition attached to it that you need to serve for 10 years to be eligible for pension. And I served for 8 years and then I took a sabbatical. So I did not get pension. I was not eligible for pension, though the employer had contributed. So it's a loss to me, though the amount may not be material, but at that point of time, it was very material. So you actually, NPS in that sense is very good because that account stays with you. So now if I were to leave employment, and I can take NPS account along with me wherever I go. And I think that's the very key feature of NPS, which is most advantageous compared to other pension fund or superannuation funds which employers have. The second benefit, I think that also has been spoken about, is the ability to manage your own account. In case of superannuation fund and pension funds that you have, you're contributing, the employer is contributing, and you get a fixed pension after the retirement age. And that fixed pension continues for a number of years. In the initial years, it's a very good amount. It's very sizable. It's very good. But as the years pass by, 20 years down the line, 30 years down the line, that amount becomes small, minuscule. And therefore, in this case, in NPS, what happens is only 40% goes into an annuity. The balance is an amount which is given to you, which you can invest on your own. And it can take care of the inflation which is there. So therefore, in that sense also, if you look at it, NPS is good because it's only a 40% of the corpus which goes into annuity. The balance corpus which is there is something which you can save and earn as per the returns which are there in the market. And the most important is the returns which you're getting. Every one of us do not have the time or the ability to really manage my own funds. So how do we save? And here we have a case where we can invest in government security. There's nothing else. I mean, if you're not a good fund manager, you don't know where to make investments. Here is a case where you have government securities giving you returns of 9%. Even fixed deposits don't give you that return now. So, I mean, it's such a safe investment, but if you go for equities and you go for debt, there is risk attached to it. But if you go for government securities, at least your investment is safe, though your return may be lesser. And mutual funds have always been telling us, we keep seeing so many ads on mutual funds. Join and you do a regular SIP investments. You hold it for a long-term period, 20 years. A few lakhs that you've invested becomes crores of rupees. I mean, that's what they say, that if you stay invested for a longer period, start early in life, stay invested for a longer period, the returns should be good. But you should have the ability to take the risk because it is still very risky. So it's not the case that everyone profits. We've seen cases, myself, I've seen cases where I've lost on mutual funds. So you have to be very careful when you're making investments in this sort of schemes. Now we come to tax incentives. Whenever we make an investment in any product, whether it's for savings, whether it's for retirement, we see the net of tax benefit that comes to us. Whatever you put in, it's very important that you should know what is the tax component of that, and then what are you going to get a return on it. So today we'll discuss tax incentives on NPS and certain changes which the Finance Act has made, whereby some part of the NPS contribution will get taxed. Now, if you look at the investment cycle, there are 4 parts to an investment cycle that we look at. One is the employer's contribution. Is the employer's contribution allowed as a deduction for the employer? Very crucial. Is the employer's contribution going to be taxed for the employee? What happens to the employee's contribution? Our government has always encouraged savings. And by encouraging savings, what they do is they give tax incentives for it. You get a tax rebate for it. So is the employer's contribution going to get me some tax benefit? What happens to the annual accretion, both for the employer's annual accretion and the employee's annual accretion? Is it going to be taxed? And on withdrawal, what is the position? We all know of PPF and everyone keeps speaking because that's something which has been there for so many years now. So we speak of PPF saying that, oh, when I contribute to PPF, I get a deduction. The interest on the PPF is not taxable. When I withdraw from the PPF, it is tax-free. Is NPS coming to that sort of a situation? So we will discuss the NPS taxation. Next slide, please. So when we look at it from an individual contribution, and this is also very peculiar to NPS. If you look at other superannuation funds, you have to be an employee for contributing to a superannuation fund or pension fund. NPS is such a thing that even an individual like us who are professionals, we can also contribute and get the benefit of retirement. Individual contribution, what happens is there's a specific section in the Income Tax Act, 80CCD, which says that up to 20% of the gross income, in case of self-employed individuals who are non-employee taxpayers, 20% of gross total income you get as a deduction. And in case of employees, 10% of the salary plus dearance allowance you get as a deduction to 80CCD. But this whole amount that you contribute gets covered within the 1,50,000 limit, which is applicable in case of 80CC, 80CC, CCC, and 80CCD. So whatever you contribute to PF, insurance, PPF, all comes within this limit of 1,50,000. And so does the contribution to the NPS also comes. But NPS has an additional deduction which is allowed exclusively for NPS up to 50,000. So if you look at it, when you contribute 50,000 additionally over and above 1,50,000, you get a full deduction for that. And if you're in the higher slab bracket, 34% of your amount, what you're contributing, you're getting as a tax benefit immediately. I mean, it's so normal. Anyone who's going to look at it will say, why not I should take this benefit because I'm getting a clear tax advantage of investing in NPS. I could have exhausted all the other limits and I can still invest in NPS. Now there's a government has come out with 2 sorts of tax rates. One is a normal tax rate, which you get based on your deductions which are there. And then they've come out now with a lower tax rate, which is section 115 BAC. The lower tax rate is basically for those people who are not able to save, who do not have much savings, who do not have much deductions. They can go for a lower rate of tax. But when we did some sort of a just offhand calculations, we found that this was more beneficial to those employees who are in the lower bracket. Those employees who are in the higher bracket, 20 and 30%, were not getting much advantage by taking the lower rate of tax. And once, of course, if you can save, then you should go for a normal rate of tax and save. Contributions made by the employer The employer gets a deduction for the contribution that they make. It is deductible in their total income. The employer's contribution to NPS was always taxable as salary. It has always been there that whatever employer contributes is a salary for the employee. However, you get the full deduction for that under 80CCD2, subject to the limits. So you have to be very careful in these limits which are there. The employer's contribution to the extent of 10% of salary plus dearance allowance in case of normal employees, and 14% of salary and dearance allowance in case of government employees, central government employees, is eligible for deduction. So generally, we have seen cases of employers, they restricted 10% of the salary and dearance allowance. So entire employer's contribution, though it's taken as salary, you get a full deduction for it. However, the Finance Act has made another change. They have now said that they will include the employer's contribution along with the other three contributions that you make to PF and to superannuation fund, and the excess would become taxable. We'll discuss the amendment which was brought about by Finance Act a little later. But today, now what we look at is employer's contribution to salary, whatever is taken, and you get a deduction, 100% of it. Annual accretion to NPS account, any accretion to the employee or individual's contribution is not taxable. Employer's contribution also, any annual accretal was there, was not taxable till last year. Now they say that if it exceeds that limit of 7,50,000, then on the excess amount, whatever the annual accretion is there, that becomes taxable only in case of employer's contribution. Withdrawal from the fund, and this is very important to be seen. Whatever you withdraw, 40% has to be mandatorily put into an annuity policy, and that 40% is not taxable. Whatever annuities you get thereafter, of course, is taxable as normal income, which would be the case any which way. Whatever you make investments, the income from that would be taxable. 60% what you withdraw is also not taxable because it's specifically given as exempt under Section 10. So if you look at it, 100% of the amount of withdrawal is not taxable from an NPS account. Partial withdrawal when you do, on case of partial withdrawal, what they've said is if an employee withdraws to the extent of up to 25% of his own contribution, then that is not taxable. Anything excess of that would become taxable. But the words used is employee. So if an individual were to contribute, whatever you withdraw partially could become fully taxable. Contribution tier 2 account. Tier 2 account is like a normal mutual fund account. It is tagged along with NPS. You get a lower rate of tax cost which is there, but it is normal mutual fund account. However, they have given a benefit to central government employees to say that if you contribute to tier 2 account, then you get a deduction under Section 80C within the overall limit of 1,50,000, subject to you holding this money for 3-year period at least. So if you satisfy those conditions, then you get a benefit under 80C within the overall limit of 1,50,000. So if you look at it, there were a lot of benefits which have been given under tax. When you contribute, you get a deduction. The annual accretion is not taxable except for when it is in excess of 7,50,000 and that too on the employer contributions. When you withdraw, again, it's exempt. So in that sense, it really becomes like an EEE sort of a scheme, exempt scheme. Now, what did the Finance Act 2020 do? The Finance Act 2020 amended the provisions saying that earlier employers' contribution to recognized provident fund was not taxable if it does not exceed the 12% under Chapter 4. Superannuation fund, what was there? We used to get this additional benefit of 1,50,000. If the employer contributes up to 1,50,000 superannuation fund, that was not taxable. Anything excess of that was taxable. And you had NPS. So the government has now, what they've done, they've aggregated all the three. Employer's contribution to recognized provident fund, superannuation fund, and NPS. If it exceeds 7,50,000, then the excess would become taxable from the last financial year. The annual accretal on this excess amount is also now going to be taxable, and they have prescribed rules for that. Because that was always a question. What would you say goes within the 7,50,000? How do you compute the annual accretal? How do you compute the taxability of the annual accretal? So they have prescribed rules for it. And the rule says, the next slide, please. Rule 3B has been introduced with effect from 1st April 2021 from the current year. And they've given a formula which is very good. A very good formula, very easy to implement. Except I think they could have worked out on the rate of return. So what they say is the taxable perquisite, which is the annual accretor, will depend on what is my contribution, the principal contribution over the year. So whatever the excess contribution that you've made during the year, employer's contribution only, divide by 2 into a rate of return. Now this rate of return is something which they have tried to be very near to the actual, and therefore they've given a formula to work it out. I think they could have just given a fixed rate because it's only a perquisite valuation. Like how you do for motor cars and you do for housing, they could have just given a rate to it. But they've tried to be very near to the actual, and therefore they've given a formula for working it out. Into R plus whatever was a taxable contribution in the earlier year, plus whatever was a taxable perquisite in the earlier years, into R. Now, how do you work out R? R is what is the most crucial thing, and that's where we think the employers will have a little problem while withholding tax. They say amount of aggregate amounts of income accrued during the current previous year. And current previous year is the year which is April 21 to 22, the current year. So the amount of aggregate amounts of income accrued divided by an average of the opening and closing balances in all 3 accounts. Divide by 2. So you take the opening balances in all the 3 accounts, the PF, superannuation fund and NPS, and the closing balance as at the year end. You divide by 2. So you derive your R is equal to I upon FAVG, the average of the balances, and that's how you derive your taxable perquisite. We've then given certain examples for it, and maybe you can go through the presentation and we can answer your queries. But I think what they could have easily done, just for simplicity purposes, they could have given a fixed rate on R. And then the question arises, in case of NPS, what do you take as accretive? Because NPS, you don't have a distribution happening. You don't have dividends being paid. You don't have interest being paid, which is there in case of PF and superannuation fund. So then you need to take the fair value as on the year end and the fair value as on the beginning of the year. The differential should be taken as the annual accretor. And that should be taken in the numerator, divided by the denominator, which is the opening and closing balances. So that's all for it. And we've given examples of how you can work out the annual accretors. And we would be happy to take any questions on this. Over to you, Mr. Sethi.
Thank you very much for that. Is one of the questions which is in front of me is pertaining to you only. And maybe in your presentation you covered it, but let us give justice to Bala Subramanian, who raised this question. What is the tax impact of growth in the tier 2 account? Do you get taxed for capital gains only on withdrawal, or you get it taxed every year?
A tier 2 is like a normal mutual fund account. So you will get taxed on withdrawal as capital gain.
Very good. Sir, there are so many questions which came, and most of these have got answered in the presentations, because all of you are experts in your own areas and you knew that what are the questions coming in the mind of people. So you have answered it. Some of the points which I am picking up and rewording them and putting it to all of you. PIT Chamber of Commerce is highly focused on MSME members spread all over the country. Some of the examples which are given are for very large companies who have gone in for NPS. How do you intend to reach to these lakhs and lakhs of MSMEs so that they can also implement this one and for the benefit of their employees? And some of the small MSMEs which we always come across are those who are employing 50 persons, 100 persons. So, question to anyone from PFRDA. Yes, sir.
Yeah, Mr. Shetty, that's a real question. Actually, how do we reach out to those people? So what we have done now, actually, we are strengthening our distribution channels. Because for a regulatory body to reach out to each and every industry and segment of industry will be pretty difficult. So what we have recently done, till now, only banks, NBFCs, these institutional agencies used to be our distribution partners. Now of late, just about month, 15 days ago, we have allowed even individuals also to get it late. And we have asked our existing distribution partners that if they wish, they can get even insurance agents and mutual fund distributors to work for them. And we are working out on a different revenue pattern for these individuals who will be coming and joining. Because without these distribution channels strengthening, we cannot reach out to each and every MSME. So that's why this kind of awareness sessions also we are arranging. If still some of your members, they feel that they really need to launch NPS for their members, they can always send a mail. I believe mail IDs also can be shared with you to whom they can send the mail. And we'll organize. Either we'll do a webinar kind of thing, or we'll organize that people should go, some of our distribution partners should go with them and ensure that it is done. Already we had a proposal with Government of India that can we have something of a little mandatory nature, in the sense that suppose once a person is inducted into the workforce, even the smaller industries which are already having less than 20, because as you know, more than 20, that is already covered by EPFO. In any case, they have to mandatorily go to EPFO if the monthly salary level is also within 15,000 rupees a month. But below that, they are not mandatorily to go to EPFO. If they choose to go to EPFO, fine. Other than that, whether there can be a nudge from the employers that, yes, I believe NPS is good for you. And thereafter, if they want to have our support, they can always talk to us. They can always send a mail to us, and we'll be too happy to support. And at the same time, obviously, the distribution channel strengthening also, I believe, will help to a great extent. So these are the ways that we are trying to reach out to them. But I tell all your members and whoever is attending today, if they are willing, kindly be in touch with us. We'll be very happy to help you.
Thank you, sir. We have a question coming from Mr. Sahu. Joined as a retiree pensioner the NPS scheme after attaining the age of 60 and am depositing 50,000 rupees in tier 1 and depositing 50,000 rupees in tier 1, full stop. How many years I should continue to deposit, and whether I will also get pension from NPA, and when can I withdraw my deposits totally?
Okay, I'm good that even people at that age also, they are thinking of joining NPS. And considering the longevity of people, what we have done recently, we have extended the joining age, which was earlier 65. Only a couple of months back, we have extended it to 70. And a person can remain invested up to the age of 75. So, Mr. Sahu, you can continue to invest up to the age of 75, which is the maximum limit. And yes, definitely you will get pension once you retire. And they are at least 40% of the total corpus. You have to convert it into an annuity. And in between, if you wish to go out, so you have to wait for 3 years. So after 63, now that you have joined us at the age of 60, after the age of 63, anytime, if you wish, up to the age of 75, you can go out. And my only this thing is that your resources permitting, if you can invest a little more, because 50,000, it is only for the income tax benefit. If your sole purpose is to get income tax benefit, fine. But in that case, what will happen? The corpus that will be there, it will not give a substantial amount of pension. That is the only.
Very good. That answers his question. When Mercer team was making the presentation, the point came out that employers should be assisting the employees in the importance of savings and NPS and all that thing. That is, again, I'm correlating with MSMEs. For large corporations, that guidance and all is very much appreciated. But small companies with 50 employees, they don't have that type of approach. And what is emerging out is, because we are also connected with, I am myself connected with insurance broking. So I'm taking you that employees need some guidance, but the major decisions are being taken by their spouses. The peer groups are more prominent, they are more confident, they are exchanging their ideas, thinking and all that thing. So how PFRDA will be able to reach the thinking process of these spouses, housewives? They might be earning also, they might not be earning, but that is that unless and until there is a support from the wife, one cannot expect that one will go on pushing for savings and for NPS. One has to bring the correlation of these two things.
So, sir, just to, yeah, so no, so I wanted to say that just to give a balanced perspective, you need support from husbands also. It's not just wives, right? When you're talking about saving. So completely agree to your point that financial decisions in families, it's not about the individuals, it's about families. And whether it's the husband deciding or the wife deciding. And interestingly, behavioral science has shown that women react very differently to financial planning as compared to men. So it's quite a complex area, and I will try and answer the question in a couple of minutes. So I agree that you need to be able to include families in these decisions. And when we're talking about, when it's large corporations, we can request the organizations to provide that nudge, to try to change behavior, include families, etc. But when it comes to SMEs or MSMEs, where the population is rather small, it gets challenging for the organization to arrange for something on an independent level. And that is where, sir, Chairman, sir, I think there's something that we can actually do together to be able to reach out to these kind of individuals. And, I honestly feel that aspects on certain biases that people have in favor of certain instruments and against certain other instruments is something that needs to be corrected through a proper nudging for them. And yeah, that's a great point in a nutshell, that that's an area that we really need to work on. Anything, sir, would you like to add?
Definitely, yours is a good suggestion. We can join organizations together, because you are connecting with the employers. So, and through them, obviously, you are reaching out to the employees. So there also, if any support from PFRD is required, we are ready to provide that support. We, of course, our very, very restricted resources, but whatever is required, we can always do that. We can have some kind of a seminar or something only for this MSMEs in a particular area.
Right.
That kind of things can happen. So if PhD Chamber of Commerce or Gurgaon Chamber of Commerce and Industries also arranges this kind of thing, especially for MSMEs and all that, and call about 40-50 MSMEs in that particular area with 40-50 employees or maybe even less. We'll be very happy to go there and give a presentation, share our ideas as to how we can do it.
Sir, we appreciate this offer of yours, and PIT Chamber of Commerce is also having some 2-3 very big foundations, PhD Rural Foundation and Family Foundation and like that. So that is, and they are having access to lakhs and lakhs of people in the lower strata of the society, where it is that number will be more important, amount will be small, but then that is what we are looking for. So PID Chamber of Commerce will be pleased to organize events for the benefits of MSMEs, not only in Delhi, but in places where we are having our own offices. It can be Chandigarh, it can be Lucknow and all that thing. And our foundations will also be pleased to work with you and with Mercer to conveying this. So while one not come up with the suggestion unless it is called for, but it's my favorite that Amul milk got prominence and the cooperative milk movement got a big push when the film which was sponsored by Amul by the name Manthan was produced, and it is seen by millions and millions of persons in this country, and that is the backbone of collection of Amul milk, processing of it, and then being sold all over the country. Maybe PFRDA can come up with a film which is sponsored, and of course professionals will produce it and they will distribute it, and it can be shown to the masses on TV, on other channels, to convey the concept of pension in a very subtle manner where it is they can easily understand it. So it is for your consideration. Now that questions are more or less answered by you, so therefore I come to the end of this one, where it is on behalf of PhD Chamber, I take this opportunity to present a formal vote of thanks. I am grateful to Shri Supratim Bandyopadhyay, Chairman PFRDA, for his most valuable expert views, for giving thoughtful insight on retirement planning. Madam Preeti Chandrasekhar, India business leader, health and wealth, and fellow actuary, Mercer. Mr. Sunil Nair, senior consultant, Mercer, for detailing on retirement benefits and planning. Shri Mono M.G. Fukon, Chief General Manager, PFRDA, for explaining all the features of NPS in such detail. And Madam Behroz Kamdin, detailed deliberations on tax implications and benefits. Madam, your tax knowledge is great, but then one has to be of that level to understand and appreciate it. But we propose that if anyone writes to you, please do answer to the person on that text question. That will be a great favor you will be doing to us. I would also extend my gratitude towards PFRDA for partnering, for being our partner, and for sponsoring of this webinar. We are also thankful to Mohit Jainji, former President, Gurgaon Chamber of Commerce and Industry, for partnering with us in helping us to spread the awareness among members of Gurgaon Chamber of Commerce. I am confident that today's session is very fruitful and advantageous for all the participants and help to clear the doubts which they were having about NPS. And it will result in encouraging many lakhs of persons through chain process in investing in NPS for future post-retirement benefits. Our offer for working with you from PID Chamber of Commerce through our foundations, through our branch offices located all over the country, we are always open to work with you, and we will have many such sessions at daily level as well as branch level and in form of virtual meetings like this. Thank you very much, all of you. I'm grateful to you for your support. Thank you.
Thank you. Thank you.
Thanks a lot, sir.
Thank you.
Thank you.